Is Robinhood about to break down? I'm Brent with Trade Therapy. Welcome back to the Trading Couch. We spotlighted Robinhood for clarity last week, and the lesson was really simple. Oversold isn't a signal, location is. Robinhood is our test case this week. It had a violent reset into a level that institutions have already proven that they cared about. So the question is pretty straightforward. Is this a defendable reset? Or is this just a bounce window inside a larger repair phase that's going to break down and distribute lower? Before we get into the charts, quick disclaimer, this video is for educational purposes only. It's not investment advice. Trading involves risk, including the risk of loss. Always trade according to your own plan and according to your own risk tolerance. Full disclosure, we don't have a position in Robinhood. Before we go chart to chart, it's always a good time to do a cycle check. Remember, institutions don't buy because something feels oversold. They buy when they can define risk. They buy when price returns to a decision level, and then they demand proof through reclaim and hold. That was really the central theme of this week's Clarity Spotlight. Let's walk through the evidence in order, beginning with this all-time monthly chart from last week. We see Hood pulling back into the same zone that defined the 2021 peak, the initial all-time high coming out of the IPO. We see a monthly trend that's still intact. We see higher highs, we see higher lows, we see price respecting and holding as of late last week. This green 21-month exponential moving average. What that means, former all-time highs are really the cleanest institutional decision point on a chart. If institutions still want exposure, this is where they're going to defend, and they're going to defend it really precisely because this is where the initial short position was taken out and flip to a long position. When you see a vertical move coming out of IPO, there's a short position taken and supply is dumped onto the market. That's when you see price come down where it's then accumulated. That position is still being held, although there's been an impulsive run out of it. There is profit that's being taken, but there is still a long position that was taken as they defined risk against the former all-time high. So there's an example of institutional buying behavior coming in where they can define risk. So what are we going to be watching out for? We want to see price defend this level. We want to see the shorter term moving averages reclaimed. We want to see monthly behavior around this prior high zone that shows that pullbacks can remain contained above it, not below it. We don't want to see these initial attempts fail and come lower. So really the key is pretty simple. A monthly level is a location. It's not a timing tool. You need to see whether or not that level holds and whether or not this tape starts behaving like demand is willing to defend it. We jump over to a weekly chart that might be a little bit easier to see. What we see in the weekly chart, we see this prior weekly breakout area holding again right around the all-time high. This is Thursday of last week. Price actually recovered on Friday, and it did hold this high, but you can see this sharp pullback down to the former breakout level and holding this sharp pullback just to take out all the weak hands that came in late and chase these highs going into the next profit taking range that we identified back in October. We had said that 150 is really the critical range to keep an eye out for. We saw profit taking coming in just like we saw the previous signs of strength. Each time you see these sharp pullbacks intended to take out all of the retail investors that chased what they thought would be easy profits because retail always expects the moves to continue. Wall Street and institutions take advantage of that to take profits and then quickly flush them out of the trade back down to prior support levels. In a healthy campaign, institutions will step in and defend this shelf right here. They may allow some volatility, but they don't want to allow repeated failed bounces. If the shelf holds, the drawdown is a reset inside of an uptrend. You'll see an initial response to it. Typically, there'll be some sort of congestion here, maybe come down, take out some of this inefficiency in this candle before it then attempts another recovery of these falling moving averages. The second test is what institutions do not want to see fail. They want to see demand greater than supply conditions take hold again. They want to see that all of the supply was flushed out of this area with this move right here. They don't want to get up to this area and then have to absorb a lot of unwanted supply. They reloaded their position down here at the bottom. They don't want to have to absorb additional supply at this point. So they will wait for a reclaim and hold. They want to see price reclaim it. They want to see price hold it. And they want to see price defend it. It's really the difference between a professional reset and a retail trap. A professional reset will reclaim these important levels and then hold them. A retail trap bounces, but then rolls over and makes lower highs and then rolls over into a lower low. And that's why the bounce is not the signal. The hold is the signal. We want to see the bounce, but we want to see it hold here. An even better look at it is to zoom even tighter into the daily. What we see in the daily is we see a fast and violent sell-off here down into this known demand zone right here. It's a known demand zone because that's where this impulsive structure continued. Once it broke past this previous profit-taking high here, demand stepped in, the markup campaign continued, and this impulsive structure continued up into the area that we identified back in October at 150 to watch out for this profit taking. So these deep, sharp flushes like this are intended to force weak hands out. They want to take out all of the retail traders that joined these trades late. Again, they don't want to absorb them back here. But what we see is a bounce window opening up because the drop was so fast. What does that mean? When price falls this hard, the first bounce is really often mechanical. It's short covering, it's reflex demand. Relief buying, if you will. Institutions care about what happens after that. They want to see that supply has been absorbed. They want to see whether or not demand can take control again and continue on with this markup campaign. So what are we watching? We want to see a sequence. We want to see the sequence that has repeated itself at these prior lows after these signs of strength. Profit is taken. There's a sharp pullback, takes out all of the unwanted supply. Price moves up to the falling moving averages, and then there's a series of small body candles right here as price reclaims, holds, and then confirms support of those moving averages. The same kind of price action we want to see here. What we don't want to see is we don't want to see price come up and reject it. So there's really two different paths that we see. We see a bullish scenario where Hood's able to stabilize in this decision zone right here. The first rebound can retake these faster moving averages, maybe come up and test this blue 200-day exponential moving average. We want to see these bounces hold and print higher lows and get back into printing higher highs. From there, the stock can start rebuilding back towards the prior range with credibility, and institutions will come back in and support the demand to push up into what we believe will be a wave 5. In that bullish scenario, we are going to be watching for RSI to form a lower high here as wave 5 completes. That is a symptom of wave 5. That'll be our next trigger that we'll be watching out for in Robinhood. The bearish scenario, price will come back up and test these. It's often price may come back and retake these falling shorter term moving averages, but then it will come up and hit these rolling over longer term moving averages and fail. Or it will reclaim them briefly, then loses them again on the next pullback. That's how overhead supply shows up. There could possibly be some more supply that's pinned up here. That's what institutions are trying not to absorb. And if they are forced to absorb it, they want to absorb it at lower levels. They can draw it out by coming up and testing these moving averages and then allowing price to come back down should supply start showing up. So this is how a bounce turns into liquidity for more selling. If in that outcome, the move stays in repair, we could see a longer term accumulation structure form. We could then start to watch for additional supply coming in and an extended volume profile at the top to see if we have distribution coming in. So if it needs more time, more basing, multiple higher lows before any durable advance can resume, that story is going to play out with how price handles these falling moving averages. Is it able to reclaim and hold and then extend, or will it come up and temporarily regain and then potentially lose? Those are the two scenarios we'll be tracking in Robinhood. That's all the time we've got for Hood this week. We'll see you back here on the Trading Couch next week.